Everybody stand back. We got another red day in the stock market and I'm going to do analysis on it.
You simply flooded the system with money.
Yes, we did. That's another way to think about it.
Honesty. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. Guys, if you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and very clear to see what happened today. The Magnificent Seven plus a couple of other smaller names were the winners. Nvidia, Apple, Google, Meta, Tesla, Amazon, they were all up anywhere from 0.2, 0.3 to as high as 4% here in the case of Tesla. I think we're just seeing a bit of a rebound, the market going through a little bit of a mini growth scare, but the broader market actually did get sold off. Everything from defensives to cyclicals, industrials, energy, real estate, defensives, utilities as well, financials too, they all got sold off, and that's because they have outperformed the Magnificent Seven. And today I think we also saw a little bit of a flight to quality. But because of the underperformance here in technology infrastructure, as well as semiconductors and software, we actually saw technology have a negative return on the day, down 0.2%, despite the Magnificent Seven names outperforming. That's because communication services was up 0.3%, the discretionary space up 1.1%. So we did see defensive stocks here at the top of the heap, kinda down 0.3, 0.3, and 0.4% respectively for utilities, real estate, and staples. And the worst performing sectors today were just highly cyclical sectors, financials, industrials, and then there was healthcare down 1.4%. But there's a lot of growth components in healthcare, especially with the GLP-1 names. They have a heavy weight, and so they did lead healthcare flows to the downside. We saw the Nasdaq actually return a positive figure today, up 0.11%, sort of just a flight to quality. We saw the S&P 500 was negative, down 0.31, the Russell 2000 down 0.41, and the worst sector today was actually the RSP, the equal weight S&P 500 down 0.58%. It was a brutal day across the board for all factor segments, but not necessarily globally. We actually saw outperformance here in Asia, most of Asia, all of Asia except Japan actually, including Australia and New Zealand. Europe was mixed. North America quite red, South America very green. So a lot of the flows we're seeing in America is sort of contained to America and certain parts of Europe. The rest of the market was green, although to be honest, a bit of a dead cat bounce because the Asia session was a complete dumpster fire yesterday, an actual dumpster fire. Like some of these indices, the Nikkei, the CSI was down like 5-6% in some regions, the Singapore market too. So maybe a dead cat bounce happening right there. And all of today's market volatility stemmed from very mixed data that we actually got pre-market. Now, we got initial jobless claims. It actually beat expectation ever so slightly, but the data pretty much came in line, if you ask me. What really weighed on market sentiment was actually the ADP employment numbers. They actually missed forecasts by a lot. Market was expecting 140,000. We got 99,000, and that's really a precursor to what's going to happen on the NFP. So the market didn't really like that, and that's why the broader market sold off. And then there was that rotation into quality, into bonds. Unit productivity came in line, unit labor costs missed, but these were revisions to the second quarter estimates. And then what really did buoy market sentiment near the open was actually the ISM services number. These came in slightly better than expected, 55.7 versus 55.1. And then the full ISM services figure came in at 51.5% versus 51%. So very mixed data. We got bad data right here, inline data right here, and upbeat data right here. And that's why we actually saw the price action we did today in the S&P 500. And in light of all of the recent price action, we saw very much the same trade we've seen throughout this week. We saw equities get sold off, although mild outperformance here in the Qs, they were positive on the day, but broadly equities were down. We saw yields fall as a result. The 2-year yield was down 0.32%, the 10-year yield and 30-year yield down 0.6, 0.9% respectively. Very interesting to see that the 2-year yield and the 10-year yield is officially uninverted, but the entire yield complex is not. The 3-year yield and the 30-year yield is really what you want to look at. and that is not uninverted just yet. That's one of the reasons why the Fed is cutting rates, to normalize interest rate policy. As a result, bonds gained. We saw the AGGTLT up 0.26, 0.57% respectively. The dollar fell, and we saw that continued rotation into safe havens, gold, silver, and then crude doing what crude normally does, and that's being a dumpster fire one day, being the best asset in the world the next day. Volatility, the VIX was actually subdued today in the context of broad-based equities actually falling, and that was very, very key as to what we saw in the market action here today. What we saw was some more bearish momentum in the gamma flip zones. Gamma flip moved from 5520 to 5500. The core resistance moved from 5650 to 5600. So these two moved down, but they put support stayed exactly where it is. Essentially, what this is telling us, with the fact that the VIX was actually down while equities were down, VIX down, equities down, and essentially what this is telling us, and I don't know for sure, is that the market or these big players are probably using butterfly spreads or iron condors to probably hedge away both the upside and the downside. That's why we saw this core resistance and they put support come more into equilibrium, when previously the risk was still skewed to the upside versus the 5400, if I'm making sense in terms of relative distance to the price target position. With the 5500 actually moving down and the S&P 500 price action as is today holding the 5500 area, we are actually technically in positive gamma. This is where it gets dicey. If, let's say, non-farms come in line, we're in positive gamma, we buy dip, sell rips to 5600, and then we could actually form a bottom right here. We then go break this high. This will be a higher low relative to this low right here. That would be trend continuation. That would be bullish. Growth scare out of the table. Maybe we get 25 basis points worth of a cut. The problem is we miss non-farms tomorrow, and the data is looking like it's going to miss because of those ADP numbers. If we miss non-farms tomorrow, we get into negative gamma. When the gamma flip has moved down, the core resistance moved down, we probably get the put support moving down tomorrow, and then things are going to get really ugly for equities, and you could see 100, 200 point sell-off, very similar to this candle we saw here, very similar to the candle we saw here. So the market is at a very, very key turning point right now. It's either we gonna balance in this zone or we're gonna completely dump to 5400 and below. So we're at a critical juncture in stock markets, but things are looking largely constructive if you actually look at market breadth. Yes, the S&P 500 has sort of traded down, but the advanced decline line is actually kind of flat. We're still seeing positive divergences right here. That is a good thing. We can also see that the market is actually in neither overbought nor oversold positioning, which means we do have room to run to both the upside and downside, and a lot's going to come down to the non-farm numbers tomorrow. Looking at the Nasdaq 100, nothing really changed in the gamma flip zone, still at the 1950 zone, and I think the market is really just waiting for that data. Guys, look at the after hours right now. The Q's down 0.23, the SPY down 0.9%. Seeing a little bit of upbeat action here in smalls as well as the RSP. I think if you see like these rip go into like really green, maybe up 0.2, 0.3, 0.4%, particularly in the Qs, that probably means the non-farms numbers got released and they might come in line tomorrow. Nothing is certain, but you know, sometimes these market makers get these numbers early, these big institutions get these numbers early and they take positions ahead of time. That's why we can rip in the after hours. So we'll see if the figures get leaked. You'll hear it first on my Twitter, so go and follow me if you want the leaked figures if we do get them. But the RTY is actually in negative gamma, by the way, here at 2150. So nothing changed in the gamma flip zones in the RTY as well as the Nasdaq 100. But what did change is the S&P 500. But that's also because there's just a ton of volume in this ticker right here. But guys, ahead of non-farms, there's not much I can tell you. The thing is, again, positive gamma, buy dips, sell rips, below it, sell into weakness, buy into strength, wait for lower levels. Once we hit our target levels, that's when you want to buy. You should really already be positioned. If you're short, you want to already be positioned right here. If you're long, you should have already taken long positions when I said to buy at this point right here. And now for us bulls, it's just a waiting game to see how the economic data unravels and to see what the market prices in for Fed funds in the upcoming FOMC. crazy. This is the AA sentiment survey, and guys, very, very interesting. Something we actually haven't really seen so far this year. We actually saw bullish sentiment tick down from 51.2% to 45.3%, and bullish sentiment also ticked down from 27% to 24.9%. And this pretty much tells us there's a lot of indecision right now because of the election, the economy, the macro, earnings, stocks, mega caps, small caps. Many people are very indecisive, and that's why they went from the bullish camp into the neutral camp, from the bearish camp into the neutral camp. And this is probably indicative of many investors probably going to cash as well. And that's why we've seen the volatility we have in the market, because investors are liquidating, but neither getting bullish nor bearish. They're just getting on the sidelines, and that's okay, because as the market goes, so too does Nvidia. Nvidia's earnings have been a key driver of broad market performance in the short term, and generally speaking, when Nvidia has performed exceptionally, so too has the market. But when Nvidia has performed poorly, so too has the market. Nvidia's earnings reaction has been highly correlated to the broad market performance over the next 2 weeks, and that probably means more downside. However, buy weakness in Nvidia because the fundamentals are completely sound. Nvidia's operating margins are high and rising. The company has seen a steep step change in projected revenue growth over the last year. Last week, the company beat expectations on revenue and earnings and announced $50 billion in a stock buyback program. Nvidia bears no resemblance, guys, to the dot-com market leader like Cisco, whose PE multiple also soared, but without the earnings to back it up. Nvidia have the earnings. Also, consensus analysts report that Nvidia will maintain 90 to 96% margin share in AI chips for the next 2 years. Even with a possible delay in Nvidia's Blackwell chip, few, if any, firms are positioned to take immediate advantage. However, competition is coming in stuff like AMD and also smaller providers like Google and maybe Intel in a couple of years. And that is a risk to the stock, and it probably won't derail the price until a good couple of years in the future. But that is Nvidia's fundamentals. What about the market's fundamentals? And we're going to look at 2025 earnings. We look at the second quarter and third quarter earnings quite a lot on this channel, and the reason why we have to start looking at 2025 is because as we go into the September-October area, the market is going to start pricing in calendar year 2025 earnings. And right now in the S&P 500, we're sitting at 14% earnings growth. The best performing sector is expected to be infotech with 19% growth, nearly 20%, and then healthcare, followed by materials, the discretionary space, then industrials. All of these are repping high teens growth. In fact, so too is comp services, and only after the sixth sector in the S&P 500 do we see growth below the teens, with financials growing at 10%, energy at the same clip, and then utilities, consumer staples, and real estate each growing 8.6, 7.8, and 5.6% respectively. However, these estimates seem very, very frothy, and I do think they need to pull back a little, and that's actually what we've sort of seen in revisions. Now, S&P 500 revisions haven't materially changed. That's because infotech and comm services have actually seen upward revisions in recent months. However, we have seen downward revisions in stuff like energy, industrials, consumer staples, and discretionary, as well as real estate. And I do think that some of these bigger sectors, we are going to see material pullbacks in their earnings. And it's not necessarily a bad thing, because the market normally expects earnings to be pared back ever so slightly. This is changing annual EPS estimates over said year, and then the annual performance in that year. Year 1985, we saw earnings estimates pull back negative 16%, and the annual return there was 26%. If we actually go to the full data, the average EPS revision is 7%, the median revision is negative 6%. However, the average annual S&P 500 performance is 10%, and the median is 13%. So even if EPS revisions do pull back and the market does pull back as a result, it's an opportunity to buy the dip, because normally it's very short-lived and we do make our way higher. Diving into the macro, looking at the Fed's GDP now, the third quarter tracking estimate, we got another update. It moved from 2 to 2.1% after some of the factory data we got yesterday, as well as the JOLTS data. The Labor Department reported that there were 7.7 million jobs open in July, down from 7.9 million. Openings have actually actually fallen steady, and what this number means is that there's 1.1 jobs per employed person in the United States. And yes, job openings have fallen steadily, but we're still above the pre-pandemic average, which is around about the 6.8, 6.9 million mark. Layoffs actually did go down. However, we did actually miss the consensus expectation here. Even though they did go down, we were expecting a lower number in layoffs and discharges, but there were some positives in this report. Total hiring rose to 5.5 million after it had fallen to a 4-year low at 5.2 million in June. And the number of people who quit their jobs actually ticked up slightly. The number of quits is actually seen as a measure of the job market's health. Workers typically quit when they already have a new job or they're confident they can find another. And that is why this is somewhat of a contrarian indicator. And this is actually ticking up sort of back to these pre-pandemic averages. So a very mixed report, and that led to very mixed trading yesterday as well as here today. And so the JOLTS report was literally split down the middle. We had good data points, we had bad data points. Such goes the market. And as election season comes around, that's obviously going to be in focus. And I thought we'd have a look at one of the election impacts that will have a material and immediate impact to stock market returns, and that is just taxes. And this is Kamala Harris's proposed tax plan. We're going to look at Donald Trump's tomorrow, and we could see here that Kamala Harris is actually planning on taxing the rich quite significantly. We have her changes outlined right here. The Harris campaign plans on increasing the corporate tax rate from 21% to 28%. That's huge. The stock buyback tax from 1% to 4%. She will increase the top income tax bracket from 37% to 39.6%, and the minimum corporate tax rate from 15 to 21%. The unrealized tax, her initial plan was to go from 0 to 25%. However, she has since run this back because there was a ton of backlash online and we haven't received an updated figure. So I guess we just remove this and see what the new updated unrealized tax gain is, if there is any, but it's definitely not going down as 25% anymore. At least that's what she's told us. And this is going to have significant impact on stocks. If we look back to December 2017, when the corporate tax rates were cut, the S&P 500 immediately rallied roughly the same magnitude as the earnings boost it ultimately received. Trump cut the corporate tax rate from 28% right here to 20%, right? The difference is 8 percentage points or 80 basis points. The S&P 500 saw an 11% earnings boost from that. And it's no different if you raise taxes. For every 1% increase in the statutory domestic tax rate, it would actually shift EPS in that same direction. So if Kamala Harris increases taxes by 1, 2, 3%, we should see the S&P 500 earnings come down as a result, excluding REITs and utilities due to their exceptional tax treatment. So who you vote this coming election is going to be really, really crucial. And when it comes to taxes, we could see immediate near-term impact in the S&P 500 in stocks because it's going to materially impact net profit after tax almost immediately. It's going to affect margins immediately. And while I don't think it's going to have any material effect in the long term because companies will learn to work around it, it will in the short term. And that's volatility we have to be aware of. Data tomorrow, we have the big one. It's non-farms. We have average hourly earnings month over month, year over year. The expectation there is 0.3% and the previous number was 3.6%. I don't know what the consensus is. Labor force participation was 62.7%. Non-farm payrolls is expected to come in at 163,000. Remember, both is expecting 200,000, and the U6 unemployment rate was previously at 7.8%, and the consensus expectation for the unemployment rate is actually to fall to 4.2% from the 4.3% mark. In terms of earnings tomorrow, we have absolutely nothing. We had a very, very light week of earnings, and it's probably going to be that way up until the end of September.